thing. I've been thinking a lot about retirement lately. Think, not my own retirement. I'm 94 years old and I have absolutely no plans to retire, but retirement in general. Think how people prepare for it, how they fund it, what they do right, and more importantly, what they do catastrophically wrong. Think, and I've noticed something deeply troubling. Most people approach retirement completely backwards. They work for 40 years, think, save whatever they can, and then simply hope it's enough. They don't have a real plan. They don't have the right assets. Think, they don't have a strategy. They just hope. But hope isn't a strategy. Hope is a prayer. Think, and when you're 65 years old and you suddenly realize you don't have nearly enough money to stop working, think, it's too late to fix it. You've run out of time. You've run out of those precious compounding years. You're stuck. Think. And that's a terrible position to be in. So today I want to talk about something critical. Think, the 5 assets you absolutely must buy before you retire. Not should buy. Not might want to consider. Must buy. Think. These aren't optional luxuries if you want a secure, think, comfortable retirement, if you want to retire with confidence instead of living in constant financial fear. You need these 5 specific assets in your portfolio. Think, and I'm not going to waste your time talking about complicated hedge fund strategies or exotic investments that only the ultra-wealthy can access. Think. These are simple, proven assets that have worked reliably for decades. Assets that generate consistent income. Think assets that protect you against inflation. Think assets that let you retire with dignity and peace of mind instead of anxiety and stress. Think. So let's dive into the first and most critical asset you need before retirement. Think. This is the foundation everything else is built on. Asset number 1, think. A diversified portfolio of dividend-paying stocks from companies with long, think, proven histories of increasing their dividends year after year. This is the absolute foundation of retirement income. Think, not bonds, not annuities, not certificates of deposit dividend-paying stocks from quality companies. Think. Let me explain exactly why this matters so much. When you retire, you need income. You're not collecting a paycheck anymore. Think. So you need your investments to pay you instead. Think. And there are really only 2 ways to generate that income from your portfolio. You can sell shares of your investments. Think. Slowly and steadily depleting your principal over time. Or you can collect dividends without selling anything at all. Think. Which one sounds better to you? Obviously the second one, because if you're selling shares to fund your retirement expenses, think. You're essentially on a countdown timer. Eventually you will run out. You will deplete your capital. Think. And if you happen to live longer than you expected, which is actually wonderful, think. But financially challenging, you're going to be in serious trouble. But dividends. Dividends can continue forever. Think, you own the shares. The companies pay you every single quarter. Think. And if you own the right companies, companies that consistently increase their dividends every single year, your income doesn't just stay flat. Think. It grows over time. It compounds. It accelerates. Let me give you some concrete examples of what I'm talking about. Think. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, McDonald's. Think. These aren't speculative startups or trendy tech plays. These are boring, stable, think, profitable businesses that have paid dividends for decades. Think. And they haven't just paid dividends. They've increased those dividends every single year for 20 years, 30 years. Think, in some cases 50 years or more. That's the kind of asset you want anchoring your retirement portfolio. Think, not speculative growth stocks that might triple or might go to zero. Not risky ventures that keep you up at night. Boring. Think, stable, dividend, growing companies that will pay you reliably and increasingly for the next 20 or 30 years of your retirement. Think, here's exactly how this works in practice. Think, let's say you retire with $1 million invested in a portfolio of dividend-paying stocks that yield 3% annually. Think that generates $30,000 per year in dividend income. Now, for most people, think that's probably not quite enough to live on comfortably. But here's where it gets interesting. These aren't regular, static dividends. These are growing dividends from quality companies. Let's assume these dividends grow at a conservative 7% annually. Which is actually below the historical average for quality dividend growers. After 5 years, you're collecting approximately $42,000 per year. After 10 years, you're collecting about $59,000 annually. After 20 years, you're collecting roughly $116,000 per year. Your income has essentially doubled, then tripled, then quadrupled over your retirement. While Social Security barely keeps pace with inflation, if it even does that, your dividend income is surging ahead, dramatically increasing your purchasing power year after year. That's the extraordinary power of dividend growth investing. That's the magic of owning great businesses that share their increasing profits with shareholders. And here's perhaps the most beautiful part of this entire strategy. You never had to sell a single share. Not one. Your original $1 million is still invested, still there, still growing in value. You can pass it on to your children or grandchildren. The dividends you've been collecting were pure income that came directly from the profits of great businesses operating around the world. I've personally lived on dividend income my entire adult life. Now, Berkshire Hathaway doesn't pay a dividend. We prefer to reinvest profits for growth. But I own other stocks that do pay dividends. And that dividend income has grown year after year after year after year. It's the most reliable, most consistent income stream you can possibly have as a retiree. So that's asset number one. A diversified portfolio of quality dividend-paying stocks. And I want to emphasize something crucial here. Not just any dividend stocks, quality ones, companies with strong, recognizable brands. Companies with durable competitive advantages. Companies with consistently growing earnings. Companies with long, proven histories of increasing dividends through both good times and bad. Build this portfolio before you retire. 10 companies, 15 companies, 20 different companies spread across different industries. Consumer goods, healthcare. Technology, industrials, financials, diversify intelligently, and then plan to hold these companies forever. That's your retirement income engine. That's what will pay you month after month, year after year, for the rest of your life. Now, let's move to the second critical asset you need before retirement. And this one works differently from the first, but it's equally important. Asset number 2, a low-cost S&P 500 index fund that you never touch. Wait a minute, you might be thinking, didn't you just tell me to buy dividend stocks? Yes, I did, but you need both. Here's exactly why these two assets work together so powerfully. The dividend stocks I just described are your income engine. They pay you cash every single quarter. That dividend income is what you live on day to day. But the index fund, that serves a completely different purpose. The index fund is your inflation protection and your long-term growth engine. Even with dividend growth, you might face extended periods of unexpectedly high inflation. You might encounter major unexpected expenses, serious medical issues, home repairs, family emergencies. Or you might simply live longer than you originally planned, which is wonderful but requires more money. For all these scenarios, you need additional assets that are growing in value over time. Assets you can tap into if absolutely necessary, but otherwise leave completely alone. An S&P 500 index fund gives you broad, diversified exposure to America's 500 largest, most successful companies. It grows steadily with the overall economy. And over long periods, 20 years, 30 years, 40 years, it has consistently delivered solid, reliable returns. You don't need to manage it actively. You don't need to pick individual stocks. You don't need to time the market. You just own it and let it grow quietly in the background. It's your backup reserve, your safety net. Your long-term growth engine that keeps working and compounding even after you've officially retired. It's there if you need it, but ideally you never touch it. Here's how I think about the relationship between these two assets. The dividend stock portfolio is like your checking account. You draw income from it regularly and consistently. The index fund is like your savings account. You don't touch it except in genuine emergencies or extraordinary circumstances. Let me show you what this looks like in practice. Let's say you retire with $700,000 in dividend-paying stocks and $300,000 in an S&P 500 index fund. The dividend stocks generate your regular income, paying you quarterly to cover your living expenses. The index fund just sits there, quietly growing, compounding, doing absolutely nothing except increasing in value. Over 20 years, assuming historical market returns, that $300 an index fund investment could grow to approximately $2 million. Meanwhile, your dividend stocks have been faithfully paying you income the entire time. You've been living well, traveling, enjoying your retirement. And now, 2 decades later, you have this massive nest egg that's grown substantially without you ever touching it. That's the power of having both assets working together simultaneously. Consistent income from dividends to live on. Substantial growth from index funds for long-term security. Together, they create a retirement portfolio that's nearly bulletproof. So that's asset number 2. An S&P 500 index fund that you hold forever and don't touch except in true emergencies. Set it and forget it. Let compound interest do all the heavy lifting. Now we come to the third absolutely essential asset you must buy before retirement. And this one is crucial. Though many people overlook it entirely, asset number 3, real estate that generates rental income. Now, before you misunderstand me, I'm not talking about your primary residence. Your house, the one you live in, is not an investment. Let me be very clear about this. Your primary residence is an expense. Yes, it might appreciate in value over time. That's nice. But it doesn't generate any income. It only costs you money in property taxes, insurance, maintenance, repairs, and utilities. I'm talking about rental property. Residential or commercial real estate that produces monthly cash flow. Property that other people pay you to use. This is genuinely one of the very best retirement assets you can possibly own. Why is rental real estate so powerful for retirees? Several reasons. First, rental income is remarkably stable and consistent. People always need places to live. Businesses always need locations to operate. Even during recessions, even during market crashes, people still need housing. Your tenants keep paying rent every single month. Second, rents tend to rise steadily with inflation over time. So as your costs go up in retirement, as groceries get more expensive, as utilities increase, as everything costs more, your rental income goes up too. It's naturally inflation-protected income. Third, real estate provides crucial diversification. It's not correlated with the stock market. When the stock market crashes and it will crash periodically. Think, that's inevitable. Your rental properties keep generating income. Your tenants don't care what the S&P 500 did today. Think, they still pay rent. That stability is absolutely invaluable in retirement. Let me give you a realistic, practical example of how this works. Let's say that 10 years before retirement, you buy a rental property for $300,000. You put $60,000 down as a down payment and finance the remaining $240,000 with a mortgage. Think, the property generates $2,000 per month in rent from your tenants. After you pay the mortgage, property taxes, insurance, and set aside money for maintenance and repairs, you net about $300 per month in positive cash flow. That's not much, right? Only $300 per year barely seems worth the effort, but wait. Over those 10 years, several things are happening simultaneously. You're steadily building equity as the mortgage gets paid down month after month. The property is likely appreciating in value, and most importantly, you're approaching retirement with a property that's almost completely paid off. By the time you actually retire, that mortgage is either fully paid off or nearly paid off. Now, that exact same property generates perhaps $100 or $500 per month in net income. That's $18,000 per year and stable. Inflation-protected income that flows to you whether the stock market is up or down. Now imagine you own 3 rental properties like this. That's $54,000 per year in rental income alone. Add your dividend stock income and your Social Security benefits, and suddenly retirement starts looking pretty comfortable. Pretty secure, pretty stress-free. Now, I completely understand that not everyone wants to be a landlord. It's real work. There are legitimate headaches involved. Tenants call you at inconvenient times. Things break and need fixing. Toilets overflow, roofs leak. It's not passive income in the truest sense. But that work is absolutely worth it for the reliable, inflation-protected income stream that real estate provides in retirement. However, if you genuinely don't want to manage properties yourself, there's an excellent alternative: REITs. Real estate investment trusts. REITs are companies that own and professionally manage properties. Apartments, office buildings, shopping centers, warehouses, and they're required by law to pay out most of their income as dividends to shareholders. You get real estate exposure and real estate income without any of the landlord responsibilities. You just own shares like you would any stock. Either way, direct ownership or rights, you absolutely need real estate in your retirement portfolio. It's proven itself over centuries, literally centuries, as both a wealth preserver and an income generator. Don't retire without this crucial asset. That's asset number 3, income-producing real estate or REITs. Stable, consistent cash flow that naturally rises with inflation. Now we move to the 4th critical asset you need before retirement. Asset number 4, Treasury inflation-protected securities known as TRUPS or I bonds for shorter-term needs. I know bonds aren't exciting, I understand that. And regular conventional bonds are actually terrible investments in inflationary environments. They're basically certificates of confiscation when inflation is running hot. But types are fundamentally different. They're specifically designed and structured to protect you against inflation. Here's exactly how types work. The principal value of a type-IS bond automatically adjusts with inflation. If inflation runs at 3%, your principal increases by 3%, and you earn interest on that inflation-adjusted principal. So you're guaranteed not to lose purchasing power. In fact, you actually gain a little because you also earn the stated interest rate on top of the inflation adjustment. Why do you absolutely need this asset in retirement? because inflation is the great silent destroyer of fixed income retirees. Think, it's the invisible thief that steals your wealth gradually over time. If you retire on $50,000 per year in income, think, and inflation runs at just 4% annually for 10 years, which is not unusual historically, you've lost a full third of your purchasing power. $1,000 only buys what $33,000 bought when you first retired a decade ago. That's absolutely devastating. Think, you're getting poorer every single year, even though your nominal income hasn't changed at all. Think TIPS completely protect against this wealth destruction. Think, they ensure that at least a meaningful portion of your portfolio maintains its purchasing power no matter what happens with inflation. Think, whether inflation runs at 2% or 8%, your TIPS adjust accordingly. That's crucial peace of mind in retirement. Think, I'd recommend having somewhere between 10% and 20% of your retirement portfolio in TIPS. Think, not the majority. Stocks and real estate are far better long-term holdings for growth. Think, but enough TIPS to give you real stability and genuine inflation protection. Think of TIPS as your defensive position in retirement. Think, your stocks and real estate are playing offense. They're going to grow your wealth over time. Think, your types are playing defense. They're going to protect what you've already accumulated. Both offense and defense matter. You need both. That's asset number 4, TIPS or I bonds, your inflation defense, your purchasing power protector. Think. And now we come to the fifth and final asset you absolutely must have before retirement. This one might surprise some people. Think, asset number 5, a paid-off house, or at minimum, very low housing costs. Wait, you might be thinking. Think, didn't you say earlier that your house isn't an investment? Yes, I did say that, and it's absolutely true. Think, your primary residence is not an investment in the traditional sense. Think, but having a completely paid-off house before you retire is still one of the smartest, most important financial moves you can possibly make. Here's why this matters so much. Think, housing is typically your single largest expense. Think, if you're paying $2,000 per month in rent or mortgage payments during retirement, that's the $24,000 per year. Think, over a 20-year retirement, that's nearly $500,000 flowing out of your accounts just for housing. Think, but if you own your house free and clear, completely paid off, no mortgage, that massive expense drops dramatically. Think, you still have property taxes, homeowners insurance, and maintenance costs. But those might only total $6,000 or $8,000 per year instead of $24,000 you've just freed up, or $16,000 to $18,000 annually. Think, that means you need significantly less retirement income overall. Think, if you were originally planning on needing $60,000 per year to retire comfortably, but your house is paid off, think you might only need $45,000. That's a much more achievable target. Think, that difference could mean retiring years earlier or with substantially less stress. Plus, think, having minimal housing costs gives you incredible flexibility and security. Think, if your investments don't perform well in a particular year, you're okay because your housing costs are minimal. Think, if you face unexpected major medical expenses, you have room in your budget to handle them. Think, if property taxes increase or insurance goes up, you can absorb it without panic. Think, let me be absolutely clear about this crucial point. Think, if you're approaching retirement, and you still have a substantial mortgage, think, paying off that mortgage should be your top financial priority, not paying extra on your car loan. Think, not taking an expensive vacation, not upgrading your kitchen with granite countertops. Pay off the mortgage first. Think, everything else is secondary. I know the mathematical argument. I've heard it 1,000 times. Think, sometimes the math says you should invest extra money instead of paying off a low-interest mortgage. And mathematically, think, That can indeed be correct under certain assumptions, but retirement isn't just about pure mathematics, it's about psychology. Think, it's about peace of mind, it's about security. Think, knowing that you own your home free and clear, that nobody can take it from you, that you'll always have a place to live. Think, that you're not one job loss or market crash away from losing your home. That's worth more than squeezing out an extra percentage point or two of investment returns. Think, that peace of mind is priceless. Now, if you're younger and you're reading this or listening to this, here's my advice. Think, buy less house than you can afford. Don't maximize your housing budget. Get a 15-year mortgage, not a 30-year. Think, pay it off aggressively and quickly. Make extra principal payments whenever possible. Your goal should be crystal clear. Think, have your house completely paid off by the time you're 60 at the absolute latest, preferably earlier, like 55 or even 50. Think, that gives you 5 or 10 solid years before traditional retirement age to aggressively build up your other retirement assets without a massive mortgage payment constantly eating into your savings capacity. Think, if you're older and you still have a large mortgage hanging over you, you essentially have two choices. Think, either commit to paying it off completely before you retire, which might mean working a few extra years beyond when you hope to retire, or plan to downsize at retirement. Think, sell your current house, buy something smaller and less expensive, and eliminate the mortgage that way. Think, what you absolutely cannot do, what would be financial suicide, is retire with a large mortgage payment and just hope everything somehow works out. Think, that's starting your retirement years with one hand tied behind your back. Think, that's setting yourself up for constant financial stress and anxiety. So that's asset number 5. Think, a paid-off house or very low housing costs. It's not an investment that grows in value. Think, but it's an asset that makes everything else about retirement vastly, vastly more affordable and achievable. All right, think. Let me recap these 5 essential assets because they truly are the foundation of a secure, comfortable retirement. Number 1, think, a diversified portfolio of quality dividend-paying stocks. This is your primary income engine that grows over time. Number 2, think, a low-cost S&P 500 index fund that you never touch, your long-term growth and inflation protection. Number 3, think, income-producing real estate or REIT, stable cash flow that rises naturally with inflation. Number 4, think, Treasury inflation-protected securities. Your defensive position against inflation destroying your purchasing power. Think, number 5, a paid-off house or very low housing costs. Think, this dramatically reduces how much income you actually need in retirement. Now, think, let me talk about the specific allocations because I know that's what everyone really wants to know. Warren, think. What exact percentage should I have in each category? How should I divide up my money? Think. Here's what I'd recommend for someone planning to retire in the next 5 to 10 years. This is a general guideline. Think. Not specific financial advice for your particular situation. Everyone's circumstances are different. Think 50% to 60% in dividend-paying stocks. These are your income generators. Think. You want them to be the bulk of your portfolio because they'll provide the majority of your actual retirement income. Think 20% to 25% in an S&P 500 index fund. This is your long-term growth engine. You're not touching this money for years. Think maybe even decades. It's growing quietly and powerfully in the background, 10% to 15% in real estate or REITs. Think this gives you valuable diversification and additional income without over-concentrating in real estate, 5% to 10% in TPs. Think, just enough to protect against worst-case inflation scenarios, but not so much that you're sacrificing growth potential. Think, and then your paid-off house. Think, which exists outside your investment portfolio but is absolutely crucial to your overall retirement security. Now, think. These percentages might shift somewhat depending on your personal situation. If you're more conservative by nature, think. Maybe you want more Type S and fewer stocks. If you're more aggressive and you're in excellent health, think. Maybe you want more stocks and fewer types. The specific numbers can flex a bit, think. But the key principle is having all 5 asset types. They work together synergistically. They complement each other, think. They protect you from different types of risks. The dividend stocks give you growing income, think. The index fund gives you long-term growth. The real estate gives you inflation-protected cash flow, think. The TPS give you stability. And the paid-off house keeps your expenses manageable. Together, think. These 5 assets create a retirement portfolio that can handle almost anything the world throws at you. Market crashes. Think. Your real estate and types remain stable. High inflation, your dividend stocks and real estate adjust upward. Think. Unexpected longevity. Your index fund keeps growing. High expenses. Your paid-off house keeps them manageable. Think. That's a retirement you can have genuine confidence in, not hope. Not fingers crossed. Think. Confidence based on proven assets that have demonstrated their value over decades. Now, let me address some common, costly mistakes people make with retirement assets, because knowing what to buy isn't enough. Think. You also need to know what to avoid. First mistake, putting too much money in bonds. Think. People think retirement automatically means ultra-conservative investments, so they shift heavily into bonds. Think. But bonds don't grow. They don't protect against inflation. They're certificates of confiscation when inflation is running hot. Think. You need real growth in retirement because retirement can easily last 30 years or more. Think. Bonds alone absolutely will not get you there. You need stocks and real estate, assets that actually grow over time. Think. Second mistake, not having enough income producing assets. Think. Some people retire with $1 million entirely in growth stocks that pay 0 dividends. Now what? Think. You have to sell shares to generate living expenses. You're depleting your capital. Think. One bad bear market and you're in serious trouble. You need assets that pay you directly. Dividends, rental income, interest. Think. Income that flows to you automatically without selling your principal. Third mistake, retiring with a mortgage. Think. I cannot stress this enough. Think. Retiring with a substantial mortgage payment is one of the worst financial decisions you can possibly make. Think. It dramatically increases how much you need to have saved. It dramatically increases the risk you're taking. Think. Pay off the house first, then retire, or work a few extra years to get it paid off. Think. Your retirement will be so much more comfortable, so much more secure. Fourth mistake, not diversifying properly. Think. Some people put everything in stocks, some put everything in real estate. But diversification protects you. Think. Different assets perform well at different times. You need multiple types working together. Think. That's why I've given you 5 distinct assets, not 1, not 2, 5. Think. Because together they're much stronger and more resilient than any single asset alone. Fifth mistake. Think. Waiting too long to start building these assets. You cannot build a proper retirement portfolio in just 5 years. It's impossible. It takes decades. The dividend portfolio needs time to grow and compound. Think. The real estate needs time to appreciate and pay down mortgages. The index fund needs time to compound exponentially. Think. If you're in your 20s or 30s, start building these assets right now. If you're in your 40s, start immediately. Think. If you're in your 50s and you haven't started yet, you need to get extremely aggressive extremely quickly. Think. Your time is running out. Let me give you a practical roadmap based on your current age. If you're in your 30s, think. Focus on aggressively building the index fund and starting your dividend portfolio. Real estate can come a bit later. Think, just get those stock-based assets growing and compounding as quickly as possible. If you're in your 40s, think, add real estate to your portfolio mix. Also start buying TEAS for stability and dramatically accelerate your mortgage payments. Think, you've got roughly 20 years until retirement. Use those years wisely and aggressively. If you're in your 50s, think, this is absolutely crucial time. You should be aggressively, urgently building all 5 assets simultaneously. Think, max out all retirement account contributions. Buy rental properties or rights. Think, pay down the mortgage as fast as humanly possible. Add significantly to your dividend portfolio. Buy TEAPs for stability. Think, if you're in your 60s and you haven't done most of this yet, I'm going to be brutally honest with you. You're in trouble. Think, you need to either work substantially longer to build these assets, think, or you need to dramatically cut your retirement lifestyle expectations. There's no magic solution here. Think, you've simply run out of time. That's the harsh truth. Retirement preparation requires decades. Think, you cannot cram it into the last few years before retirement and expect good results. It's mathematically impossible. Think, so wherever you are right now, whatever your age, start building these 5 assets today, not tomorrow. Think, not next month when things calm down, not next year when you get that raise. Today. Think, open a brokerage account and buy your first dividend-paying stock. Open a separate account and invest in an S&P 500 index fund. Think, research rental properties in your area or research rights. Buy some TEAPs through Treasury Direct. Think, make an extra principal payment on your mortgage. Take concrete action because these assets don't build themselves. Think, they require deliberate effort, and retirement doesn't wait patiently for you to get ready. Think, it arrives whether you're prepared or not. Think, I've personally seen so many people reach retirement age without adequate preparation. Think, they genuinely thought they had more time. They thought they'd figure it out later. Think, they thought Social Security would be sufficient, and now they're 65 years old. Think, still working full time because they simply cannot afford to stop, or they've retired and they're struggling constantly. Think, watching every single penny, stressed about money all the time. That's no way to spend your retirement years. Think, that's no way to spend what should be some of the best, most enjoyable years of your life. Think, but it absolutely does not have to be that way. If you systematically build these 5 assets, think, if you start now and stay consistent and disciplined, you can have a genuinely comfortable retirement. Think, not just comfortable, secure, confident, free from constant financial stress and anxiety. Think, that's what these 5 assets give you. Not necessarily luxury, but security, peace of mind. Think, the ability to retire with dignity and comfort. The ability to enjoy your retirement years instead of dreading them. Think, so let me challenge you directly right now. After you finish listening to this, take immediate action. Think, pick just one of these 5 assets and do something concrete about it today. Buy your first dividend-paying stock. Invest $100 in an S&P 500 index fund. Research rental properties online. Buy some TPS. Think, make one extra payment on your mortgage principal. Just do something. Take one meaningful step toward building these assets. Think, and then keep going. Next week, take another step. Next month, take another. Build these assets slowly, steadily, think consistently over time, and when you finally reach retirement age, think you'll have a portfolio that can comfortably support you for decades. A portfolio you can rely on. Think a portfolio that gives you confidence instead of fear. I'm 94 years old. Think, I've witnessed hundreds of retirements over my long life, good ones and bad ones. And the difference is always, think, always the same. The good retirements belong to people who built the right assets early and consistently. Think, the bad retirements belong to people who didn't adequately prepare. Don't let your retirement be one of the bad ones. Think, build these 5 essential assets. Start now. Stay consistent, stay disciplined, and retire with confidence instead of fear. Think, that's the path, that's the proven way. Follow it faithfully, and retirement will become one of the best, most fulfilling phases of your entire life, instead of one of the most stressful and difficult. Thank you for listening. Think. Now go build those assets. Your future retired self is counting on you today. Good luck.